everybody, welcome back to my Daily Dose with Tim. Today is season 2, episode 20. So as you can see, 19 and 20, they are basically the same topic. So today is part 2, and we're going to be going over, once again, the inverse relationship between cash flow and ROI. You notice that if you watched yesterday's episode already, you notice that I've actually done a couple of things to this particular flip chart because so many of you now, you caught it, and you are absolutely right. I love this, and some of you guys have been to my other trainings before. You know that I tend to like to throw curveballs at people, and so what that really means is yesterday I kept saying that, hey, we're comparing apples to apples. However, some of you caught it so quickly, and you sent me messages right away. Well, if you're actually putting down different amount of down payments, that's actually not comparing apples to apples, because what we're talking about is being able to have control over the factors that you actually have some control over, which is really putting down the 20%, and the rest of it, for example, the mortgage terms, meaning the rates and the nature of it and the amortization period, you might not actually have it, okay? And so that being said, though, that's one of the biggest things that I wanted to actually share with you, because yesterday, as you can see, the more money you put down, the more cash flow you will get. Why? Because given the calculations here, that basically means that you're decreasing your monthly expenses by a little bit. So by definition, your cash flow is going to come up, all things held equal. And by definition, that also means that your return, or cash on cash return in this case, goes up a tiny bit as well. However, I just want you to really think about when would this situation happen and how you actually can say, no, I don't want to go into that situation. Number one is the fact that people will tell you, hey, you know what, you don't qualify for this right now. However, if you put in a little bit of money, sure, you will be able to. When you do that, yeah, what they're going to sell you is based on the fact that you get to put a deal through, number one. Number two, you get to make a tiny bit more money. However, as investors, what we always look at is not just cash flow. Number two, remember, is return on investment. So what that means is your return on investment really signifies how hard your money is working. The simple question to illustrate that is, if you know your money could be making 5%, why would you want it to be making 1? If you know your money can be making 10%, why would you want it to be making 5? And so is putting down more money always the option? Probably not. And so this is where you need to develop this sharp instinct to tell yourself, okay, are there other ways for me to get into a deal rather than what I'm being told right now? And so the funny thing about this, and why I decided to do this yesterday, is that I actually had a bit of a coaching session myself with my coach. As you guys know, learning, it's continuous learning, it's lifelong learning for me, and I will always have a mentor and a coach to guide me in different areas of life as well. And yesterday we were actually on the topic of influence, and one of the questions that was asked of me was, who is the most influential person in your life? Or if you can name some influential people in your life. So people that have created impact in my life. And I started to describe my mother. And I realized that my mother, throughout my entire life, has never told me what to think. And she's always taught me how to think. Every step of the way, she's helped me develop that critical thinking skills. And that's honestly the funny thing, is how I view financial education as well. Is that, yeah, you know what, because it is real estate, so for a lot of you, you might be able to just go out there and pick up a property or 2 or 5 or 10 throughout your entire lifetime, and you'll have a very decent nesting egg. However, that is pretty much the ultimate result that you will get. What we're really learning here is financial education, is the concept of leveraging different investment vehicles. In this particular case, I'm always leveraging real estate. One day I might go into using business. We don't know yet. Maybe season 3, we'll see. So the point is, I really want to always challenge how you think and how you can develop a sensitivity, because this is money we're talking about. And especially if it's not your money and you're playing and working with other people's money, you need to be even more sharp on developing these instincts on when you need to regain that control, okay? So moving forward, I've already pre-written now. Let's just say that we're still going by, okay, I believe, let me refresh, $500,000 as our purchase price from yesterday's example, 20% down payment. That now will be basically comparing apples to apples, okay, in terms of what we have control over is we are budgeting for 20% down, okay. Again, lenders can come back and challenge that, or your mortgage brokers can come back and challenge that. However, right now, again, theoretically speaking, I just want to demonstrate the principle of the inverse relationship between cash flow and ROI. So 20% down, say one of you gets qualified at 3% over a 5-year term, whether it be fixed or variable. Usually we do variable. 30 years amortization, and the other one of you, for whatever reason, remember income, credit, in this case not down payment, however, income, credit, down payment are the 3 criteria that we all have to hit in order for us to get qualified for lending through a lender. Now, for whatever reason, let's just say maybe your credit isn't as great as person A right here, let's just call it person A, person B, shall we? Then you get 5 years term, variable as well, and 30 years amortization. However, they're giving it to you at 3.89. So still not an uncommon number these days, okay? So from a revenue standpoint, yesterday we said, I think the fair market rent, we did 2,200 as an example. So that's that. Now, you know what's about to happen. If you're my fellow Canadians and you've got the app downloaded as I've recommended, we're going back to the Canadian Mortgage app once again and go into purchase calculator. So $500,000 is our home purchase price and 20% is the down payment, okay? That means $100,000 as we saw from yesterday. And at 3%, 5-year term, 30 years, okay, I'm gonna say this is variable. Yesterday, I believe we did fixed. So what that works out to be is monthly payment is $1,682.41. So 1682.41, 1680, I'm gonna round it up to 83. Hope that's okay with all of you here. And then TI, I think I gave you a number right here. Okay, so wait a minute. Okay, TI is 500 is what we estimated. And so I'm just gonna populate that here because it's the same property. So TI is the same here. Now, going back to our mortgage calculator, instead of 3% now, we're gonna do 3.89, okay? 3.89, and what we got is 1877.25. So I'm gonna do 1878. So just rounding it up by a tiny bit, okay? So if you wanna take out your calculators now, okay, we're omitting some of the other expenses. However, this is just, once again, to prove a point. So 2,200 minus 1683 and then minus 500. So now we have a cash flow of $17, like yesterday. The other side of this is we're going to take 2,200 minus 1878 and then minus 500. And all of a sudden, you're going to go into minus 178. It's pretty crazy, hey? How 0.89% amortized over 30 years can create that kind of a gap. The gap right there is about $195 per month, which means basically that's the main difference right there, okay? So this now, based on a return perspective, it's not even worth it to look at. So I keep telling you that I'm definitely overestimating the taxes and insurance on this property right now. So what I'm going to quickly do now is to demonstrate to you if the property is performing a little better. Remember, S&P, strategy, market, and then property. So you want to pick a market where the property or fair market rent in this particular case is actually performing a little bit better than 2,200. So if we change that, even just by a couple $100 right now, okay? what that's going to do is, as you can see, it's going to become 217 instead. And this one right here, okay, is going to have a cash flow of $22 now. So when we're doing that math, let's go back and figure out what the ROI is now, or the cash on cash return in this scenario. 217 times 12 months divided by how much money do we actually have to leave in the deal or to incur to get into the deal. In this case, it was $100,000, right? So cost of acquisition is 103. So this 103 number would actually not apply to both of them because they would have the same return. Remember, if we're comparing apples to apples, that means our initial investment needs to be fixed. Okay, yesterday threw a curveball at you. So today we're gonna fix it at the same number. So 217 times 12 months divided by 103,000. We're gonna get a number of 2.53%. This is our cash on cash return. Now, the other side is $22 times 12 months divided by 103,000 as well. And all of a sudden, we have 0.26%. Curveball again? You got it. Okay, because what I did here is, once again, these numbers. These numbers we have no control over, okay? This number we do, that we don't. So what I want to do is I actually want to make sure that you guys are really fully picking up on the concept of all of this, which is, this is going to be your homework. Because remember, week 1 we had homework, week 2 we had homework, last week we actually didn't do homework. This week, I want you to actually think about what are the factors that would help you, okay, structure and increase the performance of your deal. Okay, what are the factors? And to be more specific, what are the factors that are within your control to help you create not only better cash flow, okay, but also better return on investment, okay? Also better return on investment. So what we're going to do is we're going to park that there, and we're going to use this as your homework item. So you can see now right here, I have 3%, 3%, 25% down with the same thing, okay? And so 25-year amortization, that one should be 25-year amortization. So as you can see, okay, I'm already giving you a very, very strong hint. I'm already giving you a very, very strong hint on how this is going to work. 25%, because we already went through one example yesterday, another example today, okay? So really, it is not about this part, because this part will dictate, meaning your mortgage terms, will dictate your cash flow and your ROI to move in the same direction, okay? I want you to start to develop that sensibility, that sensitivity also to really figure out, and I'm already giving you the hint once again, this doesn't change. This is held constant. What can we do to make sure that we actually garner and generate better cash flow and return at the same time? And how that all fits into what we keep talking about, the SMP process, okay? So the SMP process, strategy, market, and properties. So that is what I'm going to leave you with today. There is homework once again, as you guys know now. So I hope you really do take the time. So for those of you that are watching from other places, make sure you also do your homework. And for those of you that are my fellow Canadians, happy Thanksgiving weekend. I know you might have a full weekend planned with dinners and families. I don't know, maybe if we don't right now. I know we don't, but I know it's Thanksgiving weekend. Regardless, I really just want to let you know how thankful and how grateful I am for your support, for your input, for your engagement, because I can really truly see that you guys are actually interacting with me and you're learning, and you tell me that I'm adding value and I'm putting out the content. So I'm very, very grateful. And more importantly, thank you for sharing the videos with those who you think can actually start learning as well. So with that said, have a great Thanksgiving weekend, my Canadians, and live well, everybody. I will see you back here on Thanksgiving Monday next week.